Hello and welcome to The Explainer. So, you're a complete newcomer, right? Looking to make sense of the wild, sometimes completely chaotic world of currency markets? Well, you are in exactly the right place. Today, we are focusing on creating a truly actionable roadmap to help you start trading Forex successfully. We're cutting through all the noise out there, using our source material to take you from a total beginner to a thoroughly prepared trader. We've got an incredible, step-by-step roadmap lined up for you, derived straight from expert insights. So, grab a notepad and let's dive right in.
Okay, here is our game plan. We're going to break this giant, complex subject down into 5 clear, totally manageable stages. We'll start off by defining what Forex actually is. Then we'll walk through your exact beginner setup. After that, we'll explore how to build a real market edge, lock down your risk management, and finally, set some realistic expectations. Let's get started.
Starting with stage 1, what is Forex trading anyway? Let's take a look at this absolute behemoth of a market.
The foreign exchange market is staggering. We are talking about an average of $7 trillion changing hands every single day. $7 trillion! But you really need to look at who is actually doing the trading here. Over 90% of that money flow comes from massive institutional players. We're talking central banks, mega hedge funds, and giant investment firms. Normal retail traders, which includes you and me sitting at home at our desks, we make up a tiny 5% sliver of the market. Understanding this massive imbalance, that's your very first step in realizing exactly how we have to play this game.
Now, inside Forex, you aren't buying physical stacks of cash. You trade what's called a currency pair, which is basically a contract comparing the value of two currencies against one another. The mechanics here are simple but absolutely vital. The base currency, the first one listed, is always exactly 1 unit. The quote currency, the second one, tells you the equivalent value of that one single unit. So if you see the euro to US dollar quoted at 1.09, it simply means 1 euro equals 1.09 US dollars. Easy, right?
Knowing how these pairs work, we can actually build your trading list. Because listen, not all currencies are created equal. Our source strictly puts them into 3 buckets. First, you have major pairs. These always include the globally dominant US dollar, and they offer by far the best trading conditions. Next are minor pairs, or crosses, which include major global currencies but leave out the US dollar. And finally, we have exotic pairs. These pair a major currency with an emerging market currency, like, say, the Mexican peso. The source explicitly warns beginners to completely avoid exotics. The price moves are just too erratic. Stick purely to the major pairs for the most reliable, stable path to success.
And here is where it gets really interesting. Because we're trading digital contracts rather than holding a physical asset like a gold bar, we actually have double the opportunity. If we think a currency's value is going to rise, we can go long, meaning we buy the contract now to sell it later at a higher price. But if we think the currency is going to fall, we can go short. This means we enter a contract to sell high right now, locking us in to buy it back later at a lower price. You can literally profit when the market drops just as easily as when it climbs.
Now, to measure these tiny everyday price movements, the industry uses a metric called pips. A pip almost always refers to a microscopic change in the 4th decimal place of a currency's quote. So, if the price moves from 1.2695 up to 1.2696, that tiny little jump is exactly 1 pip. Think of it as the standard unit of measurement for all your potential profits and losses.
All right, let's keep it moving to stage 2, the beginner's setup guide. This is where we gather your essential gear so you can actually get in there and execute trades.
Here is your exact, literal 4-step setup roadmap. First, you need a broker account to facilitate your trades, and the source recommends solid, reputable names like IC Markets or Vantage. Second, you need a trading platform like MetaTrader 4 or 5, which is where you'll actually log into your brokerage to hit the buy and sell buttons. Third, you absolutely need dedicated charting software to analyze the markets, and TradingView is the unrivaled champion for this. And finally, step 4, and honestly the most important one, you need to open a demo account.
I really need you to hear this warning. Our source is brutally honest about this part. When you set up that brokerage account, you're going to have the choice between a live, real money account and a demo account. You absolutely must choose the demo account. It uses fake money. It functions exactly like a video game where you can test your strategies and learn the platform without any financial ruin. The source guarantees, literally 100% guarantees, that if you skip the demo and use real cash while you're still learning the ropes, you will lose all of it. Take this warning seriously.
Okay, on to stage 3, building your market edge. This is where we completely shift your mindset to view trading as a highly calculated form of gambling.
Let's unpack this concept of a market edge. At its core, trading is a game of probabilities. You are going to lose trades. I'll say it again, you will lose trades. There is absolutely no strategy out there that wins 100% of the time. But think of a casino playing blackjack. They have a slight mathematical edge that guarantees they profit over thousands of hands, right? You have to craft your own personal edge, an edge that ensures that, despite your inevitable individual losses, the sheer math guarantees you come out profitable over a series of trades.
So how do you actually build that edge? Well, our source advises completely ditching standard retail strategies. Don't just draw basic trend lines or hunt for generic head and shoulders patterns. Remember earlier when we said 95% of retail traders lose? Yeah, that's what they're doing. Instead, you need to focus your technical analysis on logic-based concepts. Look at institutional supply and demand, market efficiency, and market structure, and pair that with fundamental analysis. That means looking at real-world macroeconomics and government actions to figure out the true underlying strength of a currency.
Which brings us perfectly into stage 4, the power of risk management. This is your ultimate shield in the market, and arguably the single most critical survival tool in this entire explainer.
To really set the stage for this, just look at this incredible quote from the legendary investor Peter Lynch. He said, "In this business, if you're good, you're right 6 times out of 10. Think about that for a second. You do not need to be right all the time to make a fortune. In fact, expecting to be right all the time, that is exactly what leads to highly emotional trading and totally blown bank accounts." It all boils down to the beautiful math of risk versus reward. Our source highly prefers a risk-reward edge over trying to maintain a super high win rate. Let's say you structure your strategy to risk $100 on a trade with the goal of making $300. That's a 3-to-1 reward. With that setup, you can actually lose 6 out of 10 trades. You can literally be wrong 60% of the time. Yet because your winning trades are 3 times larger than your losing ones, you are still highly, consistently profitable. This completely takes the stress out of trying to win every single time you click a button. But to enforce that mathematical edge, you need bulletproof rules. First, you have to place an automatic stop-loss order on every single trade. No exceptions, ever. If a trade goes against you, the system just cuts it automatically before the loss gets out of hand. Second, you should only ever risk 0.5% to 1% of your total account balance per trade. And third, to figure out exactly how big your trade size should be to keep that strict 1% risk, you just use an online position size calculator. No complex mental math required, just absolute unwavering discipline.
And that brings us to our final stop on the roadmap. Stage 5, realistic expectations for traders. It is time to align our mindset with the reality of where we're going. There is just a massive, glaring contrast between internet marketing and the actual craft of trading. You have to forget the social media myths. Ignore the overnight Lamborghinis, the guys flipping tiny accounts, and the claims of 100% weekly returns. Our source makes it crystal clear. Real, professional trading is about slow, steady, consistent, compounded growth. A truly exceptional trader is aiming for a modest 4 to 6% average growth per month. Now, that compounding can absolutely lead to massive, life-changing wealth over a few years, but make no mistake, it is not a get-rich-quick scheme.
So, I want to leave you with this final provocative question straight from our source material. Ask yourself, are you here for the passion of the craft or strictly for the profit? Because the reality is, the learning curve here is incredibly steep. It's mentally taxing and it's often expensive in terms of your time and lost demo or real capital. If you are only chasing easy money, well, there are much easier businesses to start out there. But if you are genuinely passionate about mastering this logical, probability-based craft, you now have the realist's actionable roadmap to begin your journey. Thank you so much for joining me on The Explainer. Keep studying, stay disciplined, and until next time, keep learning.